Hello, my name is Maxwell Reilly, and I'm here today to present my analysis on why Novartis is an undervalued stock. As you can see, we project an upside of between 16 and 27% with relatively little risk. Novartis is the second largest pharmaceuticals company in the world with a market capitalization of $255 billion US dollars. Recently, global macro trends such as the Swiss franc revaluation and stagnation in the Eurozone have caused some of the company's performance metrics to flounder. In our view, the market has overestimated the risk inherent in Novartis. The Holt Momentum tool, which gauges the market sentiment of a stock, shows this, giving the stock a score of just 32. Looking closer, we can see that the reason for the dismal market sentiment actually stems mainly from two factors, the turbulence in the Eurozone and the recent revaluation of the Swiss franc. In reality, Novartis accrues the vast majority of its sales from outside of Europe, meaning it should be valued as a global company, not a Euro-centric one. In addition, the Swiss franc is stabilized against the euro. This means that the low momentum score given by the Holt valuation framework presents a more pessimistic view than is warranted. Looking at the CFROI chart, we can see that CFROI increased until around 2010 when it began to fall. Returns have been well above the cost of capital for the last 20 years, and it looks well positioned to continue this trend into the future. You can also see that the market expects a significant decline in CFROI to almost half of the 2010 level. This is likely much too quick a decline for the very long-term oriented pharmaceuticals business. Novartis has been less consistent in growing its asset base. However, the recent declines can be traced back to the global financial crisis of 2008, the 2011 Eurozone crisis, and its successor in 2014. Since the crisis of 2008, Novartis has shown robust, above-market growth and can be expected to continue this trend into the future. Sales growth has not been steady, but the reason for this can be traced back to the recent euro and world crises. Margins have shown solid growth due to ambitious measures by management to make more efficient use of information systems and cut fat. Most large pharmaceuticals companies have a strategy that we call buying innovation. Due to high regulatory and research costs, small pharmaceuticals firms with brilliant drugs must either partner or be bought out by larger players like Novartis. For that reason, we believe that the fate inherent in the Holt model will be less prevalent for pharmaceuticals companies. With this in mind, we've used the Holt Flex valuation tool to lengthen the expected fade time in the model. With these modified assumptions, we can take our estimate of the upside from 16% to 27%. Novartis has a very attractive valuation percentile, ranking second in its peer group just behind Roche. This means that Novartis has a low stock price relative to the value warranted by the Holt DCF framework. In addition, Novartis is valued at just 1.35 times its wind-down value, well below its peer group median. While any company has risks, this 250-year-old pharmaceuticals giant is well positioned to manage them. The traditional leverage ratio puts its leverage substantially above its peers at 8% versus a 4% median. However, when we look at the Holt leverage ratio, which dives deeper and adjusts for off-balance sheet liabilities, we can see that it is actually on par with its peers. Despite the risks, Novartis is a great pick in today's market. The strong risk profile, combined with a slower fade rate and a massive global presence, makes Novartis a strong buy.